As we head towards this new quarterly earnings season, there has been a lot of concern about expectations for growth being brought down.
Yes.
Is that baked in? Have we seen everything we need to see?
I think more than baked in. You're at negative 4% year on year, and if typical revisions hold, you should be back to flat. So revise positive by 4% by the end of earnings season. So I think much of it's baked in. And anecdotally talking with clients over the last 2 weeks, it seems pretty clear that the big boogeyman now for markets is earnings being very weak and not ramping up in the back half of the year. So I think it's very well vetted.
Yeah, I mean, you say that mathematically really doesn't make that much of a difference, but how important is it psychologically that we get a positive earnings season? I
think it's very important psychologically that we don't see worst fears confirmed. There's continues to be boogeymen around margins, and so you see a lot of commentary about the margin outlook potentially being very weak. The ability to actually meet expectations of the back half of the year where corporates bring down guidance significantly. And if you don't see the worst fears of those come to fruition, psychologically it's going to look pretty positive in my view.
Something that you were pointing out that's really interesting is the new growth orders number relative to inventory. New orders number relative to inventory.
From the ISM, yes.
And what it says about growth when we look at the ISM.
Yeah, it says that the ISM for the back half of the year should be a little bit better. It's not going to give you precision around the ISM, but it's going to point in the right direction, which will probably make analysts a little more comfortable that the global growth outlook should stay above 3%.
Does that also give us comfort on profit margins, if that's what we're really watching? Yes,
no, it should give you much comfort on profit margins. What you worry about on profit margins is a significant increase in the dollar, and that's where I'm most concerned about the profit picture, if there is one. You see top line kind of estimates come down if the dollar were to go up a lot. And although we don't think that could happen, that seems like a plausible risk if rest of world growth stays really weak over the next 6 months.
To your point, we have CPI data this week as well, and President Trump really weighing in on the inflation debate, talking about that there's a need to cut because there's basically no inflation. If we do see inflation subdued, does it make sense to cut rates at this point?
No. There's no
Simple
reason.
No.
Yeah, I mean, you're pretty much around target for core PCE, which is the Fed's target. I don't see why you'd want to try and cut rates to push it significantly above that. I certainly agree that there's no need to tighten financial conditions, and some financial conditions could ease, and we could see inflation gradually move higher. That's all very good for the market, but cutting seems aggressive.
So in terms of what would create a strong dollar, if that's one of the risks out there, obviously if we take the rate picture out of it, because if we stay where we are for a while, is it external factors that make it once again the most attractive option?
Absolutely. The biggest concern there, and I think a lot of the market hinges on this, quite frankly, is Chinese economic growth or stimulus not coming to fruition or having the impact that people think it will. So we happen to think that China will be successful in stimulating economic growth, but if we're wrong on that, then global growth estimates come down and the outlook for Europe becomes very concerning, because a stable China will kind of get Europe off the front page as far as inflation risk there becoming significantly unmoored to the downside. And Germany, the biggest economy in Europe, is a significant exporter to China, so China filtering into some stabilization in Europe. If you don't get that, then European growth outlook weakens further, inflation expectations decline, the euro goes down, dollar goes up despite a Fed that's relatively dovish.